A wonderful day to you all. Welcome to Nifty Sense. Have you ever watched a sprinter stumble just inches before the finish line? That is exactly what the Nifty 50 did today. We were poised to conquer the psychological 25,800 mark, but a sudden invisible hand pulled us back. What was this force? Was it just profit booking? Or is the new tariff tantrum from the US the beginning of a deeper correction? Today we decode the hidden narrative behind the red indices and uncover why smart money is quietly moving into sectors you might be ignoring. Today's market texture can be described in one word: fragile. The Nifty 50 closed at 25,732.30, down 0.22%, while the Sensex shed 250 points to close at 83,627.69. The primary trigger was geopolitical. News of a potential 25% tariff on Iran's trade partners by the US administration sent shockwaves through global supply chains. Think of tariffs like a toll gate on a highway. Suddenly, moving goods becomes more expensive, slowing down the traffic economy. This geopolitical tension pushed crude oil prices up by over 1%. For India, which imports over 80% of its oil, this is like a tax hike on the entire economy. Higher oil means higher input costs for companies like Asian Paints or Pidilite, and higher inflation risks. FIIs, foreign institutional investors, executed a massive sell-off, with net outflows recorded at a staggering 10,907 crore rupees provisional. This suggests global funds are de-risking or pulling money out of emerging markets to safety. However, DIIs, domestic investors, acted as the shock absorbers, buying 6,534 crore rupees, preventing a freefall. Despite the sea of red, two stocks stood out like lighthouses in a storm, showing what we call relative strength. Candidate 1, ONGC, Oil and Natural Gas Corporation. The hedge logic. When the market fears rising oil prices, ONGC often parties. As an oil producer, higher crude prices directly boost their realization, profit per barrel. Institutional footprint. While the broader market fell, ONGC surged 3.3%. This divergence indicates that institutions are using ONGC as a hedge against inflation. If you fear the market falling due to oil, you own the stock that benefits from it. Value moat. The stock is trading at a valuation that offers a significant margin of safety compared to private energy players. The order book for their new exploration blocks adds a layer of future revenue visibility. Candidate 2, NBCC India Limited. The catalyst. The stock showed resilience backed by a massive fundamental shift. NBCC signed an MOU with Bharat Electronics, BEL, to develop healthcare infrastructure. The real-world analogy. Imagine a builder, NBCC, partnering with a high-tech security firm, BEL, to build smart hospitals. This isn't just constructing walls, it's creating high-value assets. Order book visibility. Construction is a cyclical business, but healthcare infrastructure is a structural need. This pivot reduces the cyclical risk for NBCC, making it attractive for long-term accumulators who prefer steady compounding over quick gains. While real estate and consumer durables bled, the Nifty IT index closed green, plus 0.65%. Why? The rupee weakness factor. As the rupee fell 4 paise to 90.21 against the dollar, IT companies, who earn in dollars, saw their earnings value increase. The accumulation. Stocks like HCL Tech and Tech Mahindra showed resilience. This suggests that in a volatile market, investors are hiding in IT, the digital gold of the equity market, expecting that even if the physical economy slows down due to tariffs, the digital economy will persist. The macroeconomic tariff tantrum and the invisible tax. Let's pause the ticker for a moment and look at the engine room. You heard me mention tariffs and geopolitics earlier. Many of you might think, sir, I own Tata Motors in India, why should I care about a tax on Iran or US trade policy? Let me give you the butterfly effect analogy. Imagine the global economy is a giant interconnected water pipe system. The US economy is the main pump. When the US imposes a tariff, a tax on imports, it's like they are squeezing a section of that pipe. They want to keep the water, money/jobs, inside their own tank. But here is the catch. When they squeeze the pipe, the pressure builds up elsewhere. Input cost inflation. If the US blocks cheap goods from entering, their own prices go up. To fight that inflation, their central bank, the Fed, keeps interest rates high. The dollar vacuum, high US rates, act like a giant vacuum cleaner, sucking dollars out of emerging markets like India back to the US. That is exactly why you saw FIIs selling 10,000 crore rupees today. They aren't selling because Indian companies are bad. They are selling because the yield, interest, in the US is becoming attractive again. So what does this mean for your portfolio in 2026? You need to audit your stocks. Ask yourself, Does this company rely on cheap imports? Or does this company have heavy U.S. debt? Danger zone, companies with high U.S. dollar debt. If the rupee falls, as it did today to 90.21, their loan repayment amount automatically increases. This is the invisible tax, destroying their profits. Safety zone, companies that export services, like IT, or companies that source everything locally, like FMCG or PSU Defense. This is why we saw Tech Mahindra green today, while heavy importers bled. The retail trap psychology, how to master the fear of missing out, FOMO, and fear of being sucked in, FOBSI. I want to address a dangerous behavior I saw on the charts today. At 10:15 a.m., when the Nifty dropped 100 points, retail investor buy orders spiked. By 2 p.m., when the market fell another 100 points, those same retailers panic sold. This is what institutions call the liquidity sponge. Big players, FIIs, DIIs, cannot just buy or sell huge quantities whenever they want. If they sell 1 million shares of HDFC Bank at once, the price will crash instantly. So they need liquidity. They need someone on the other side to buy while they sell. The trap. They let the market float up slightly in the morning, the bull trap, to entice you to buy. Once enough retail orders are in, they dump their stock into your buy orders. You provide the exit door for them. How do you stop being the sponge? Adopt the 10:30 to 2:30 rule. Amateurs trade at the open, 9:15 to 10 a.m., based on emotion and news headlines. Professionals trade at the close, 2:30 to 3:30 p.m., based on the day's confirmed trend. In a falling market like today, January 13, 2026, never try to catch the falling knife in the morning. Wait for the settlement after 2:30 p.m. Notice how ONGC held its levels till the end. That was confirmation. That was the signal to enter, not at 9:15 a.m. Advanced sector analysis, the hidden sectors, beyond the headlines, chemicals and logistics. We talked about oil and IT, but there is a silent war happening in two other sectors, specialty chemicals and logistics. 1. The chemical renaissance, China Plus One, Strategy 2.0. With the U.S. putting pressure on trade partners, global companies are desperate for a backup plan to China. India is that backup. The shift. Look at stocks like SRF or Deepak Nitrite, hypothetically. They have been consolidating for 2 years. Why? Because they were building capacity. Now, in 2026, those plants are live. The green flag, watch the feedstock prices. Crude oil is up, which usually hurts chemical companies. But if these companies have pass-through clauses, meaning they can pass the cost to customers, they are safe. The companies that cannot pass on costs will perish. Stick to the market leaders here. 2. Logistics, the veins of the economy. If the government is pushing for Make in India and PLI schemes, goods need to move. The play, Container Corporation of India, Concor, or private players like Delivery. Even if the market falls, goods still need to move. The logic, in a high-inflation world, 2026 scenario, efficiency is king. Companies will pay a premium for logistics partners who can save them time. This sector is a structural compounder. It grows slowly but surely, regardless of the Sensex mood. The Value Moat Deep Dive. How to read an order book like a pro. I mentioned NBCC's order book earlier. Let's decode what that actually means, because this is your biggest edge as an investor. Most people look at earnings past. Smart investors look at the order book, future. Imagine you run a bakery. Earnings. I sold 100 cakes yesterday. Great, but what about tomorrow? Order book. I have confirmed pre-orders for 500 cakes for next month's wedding season. The book-to-bill ratio. This is the magic number. It is the ratio of orders received versus orders fulfilled. NBCC's magic. If NBCC has a market cap of 30,000 crore rupees, but an order book of 60,000 crore rupees, that gives us revenue visibility for the next 2 to 3 years. Even if a recession hits in 2026, they have work to do. They have cash flow secured. The warning, be careful of slow-moving orders. Sometimes companies announce huge orders that never start, like some infrastructure projects stuck in land acquisition. Always check the execution record of the management. An order on paper is useless. An order on the ground is gold. Today's lesson is about correlation. When the geopolitical risk dial turns up, the oil importer stocks, paints, tires go down, and oil producer stocks, ONGC, go up. Wealth preservation today wasn't about selling everything. It was about rotating capital into the right bunkers.